Good morning. It's not afternoon. Good morning, everyone. Thank you for joining today's workshop. My name is Vartuhi Andreasyan. I'm a business counseling manager at PACE Business Development Center. So many of you may know PACE, but I will just briefly talk about PACE. PACE is a nonprofit community development organization, and we are like, this is the first 50 like 1 year that we are in the service. So we have many different departments. It includes childhood education, workforce development, energy efficiency, and I am from business development department. So in the Business Development Center, we support entrepreneurs in the Southern California by offering business counseling, procurement assistance, and access to capital. All our services are free. So if anyone comes to our doors, we tend to serve everyone. In the same time, I would like to share that City of Los Angeles has 10 business source centers, and PACE hosts of those business source centers. We are like certified CDFI. We are like SBA microlender, EDA, and iBank lenders too. So today's workshop, I just want to say thank you to Citibank team. This is in collaboration with them to bring you this workshop. Saloni Rodadia will do the presentation today. We also have Annabelle Santa Maria, market manager from City Community Investing and Development team with us. So in this workshop, from like the topic you will see, we will talk about the differences between personal and business credit, and why both are important for entrepreneurs and how they can affect your ability to access financing and grow your business. So as always, we will have Q&A session at the end, but from the style of Saloni, I know she pauses. If you have any question, you can ask your questions, and we encourage you to get engaged with your, with the presentation, and you can write your questions using the Q&A box. At the end, we will give the opportunity to unmute yourself and ask your questions. So with that, I want to hand it over to Saloni to introduce herself and get us started. Thank you so much.
Of course. Thank you, Vartuhi. And thank you everyone for being here, and apologies for being a few minutes late. I had some technical errors. I will kickstart, but a little bit of background. I've been working at Citi in corporate banking, which involves a lot of lending to large cap, specifically healthcare clients. And that's where we evolve a lot of like the credit risks, the 5 C's of credit that we'll dive into. And I'll start sharing my screen to just kind of go over like a quick snapshot. But again, like Vartuhi said, if there's at any point you want to stop and just unmute yourself for any questions, or drop it in the Slido, whatever is easier, and hopefully we can make this into a interactive session. Feel free to stop me at any point. But hopefully you all can get some insights from today's session. Correct. Let me know if you're able to see my screen.
Yes.
Okay, great. So basically, here's some of the things that we'll be going through today, right? Just big picture on like what credit reporting is. How does that matter for like my business? What is the impact differences between personal and business credit? What is the impact of personal on the business? How do lenders kind of evaluate credit worthiness that I mentioned earlier? And then just differences in terms of the credit reporting and business operations. We will also dive into a little bit of detail on like agencies and different types of metrics that go into evaluating a credit score that gets assigned to your personal or business like credit reports and scores, as well as just how lenders and others are using the information to kind of, determine what kind of loans are to be used. So before I kick off into the topics, anybody who wants to, like, what do you currently know, and like, what are you looking to gain? If it's helpful to kind of pivot to like one topic over the other, like, happy to do that as well. But if maybe somebody wants to just raise their hand and maybe focus on like, are there specific topics that you want to touch on? But we'll also have opportunities towards the end of the session and throughout the sessions to kind of address any specific questions. But I'll pause here for like a quick 5 seconds if anybody has anything on their mind that's pressing.
If you would like to unmute, please raise your hand and I can unmute you.
I think we can get
Yes, please.
started. Okay, perfect. So before even starting, right, like credit is essentially a very important financial tool that really allows individuals and businesses to borrow money and just like access any goods and services with obviously the promise of, that repayment in the future. And it really measures like the trust and the reliability. And for small businesses, especially, I think it's really important to just maintain that good credit. It's fundamental in sustaining operations, just expanding and weathering any financial changes that come along the way. And poor credit obviously is a reflection of just limited access to financing. Also is expensive because it increases your borrowing costs and just like hinders like growth opportunities, right? And this is when we come across one of the key areas that I told that we are going to touch on, which is credit reporting agencies and why that's important to your business. Um, they play a pivotal role in the financial system. They provide valuable information about any individuals, whether that's on a personal level or businesses like credit worthiness. So these agencies, they gather data from various sources, whether that's banks, whether that's credit card companies, lenders, to really just compile like a comprehensive report. And to clarify, these credit reports are different. They could be personal credit reports or they could be like business credit reports. And they detail about like an entity's like borrowing and repayment history, what are the outstanding like debt balances, any other like financial behaviors. And for small businesses, especially, these agencies, they serve as a kind of like a centralized source of information that lenders use to really assess like credit risk and just, when they're considering like loan applications that you submit for your own respective businesses. And this is when this is kind of like a key important point that really helps them make informed decisions about, extended credit, like determining what interest rates they're going to charge you, and then really just setting the additional loan terms and conditions. Um, and that's what brings us to this is something that we touched on earlier, and now it we talked about the two types of credits, right? Which is like a personal and business, like super straightforward. Personal pertains to individuals like financial activities, including like any personal loans that you have, credit cards, like mortgages, payments. And then business credit, on the other hand, really focuses on the financial performances and the obligations of the business itself. And while personal credit can really influence your business credit worthiness, establishing separate business credits is just super crucial for just protecting your personal assets and fostering the growth of the business. So building strong business credit really involves like, opening accounts in the company's name, making payments on time, and then just maintaining a positive financial track record overall. And this is where you will see that it's a very simple cycle. You access the financing, you get capital, right, based on your credit and your past historical performance. And the next thing you would want to think of is like maybe acquiring or manufacturing inventory. And then you purchase it and then you eventually start managing your working capital. And as any small business, like a business needs cash or working capital, right, to just cover its daily operations. These daily operations may include like rent, inventory, payroll, and that's how it becomes like a viscous cycle of just like, getting capital, putting it to use, and then eventually like purchasing stuff and then managing it. Next, we really talk about a spectrum where you will see that although they're fully separate, they can influence each other depending on what stage your business is in. And before you have the business established, your personal credit matters a lot because that's what the lenders are focused on. And then as you grow, business credit becomes increasingly important, right? And then when you look at this slide, um, before we move a little bit like earlier, maybe if somebody wants to maybe stop and say, um, have you applied for business loans or lines of credit in the past? What information and documentation did the lender obtain or request from you during the loan application process? Did the lender, tell you if you or she would need to check your credit history? If anybody wants to maybe unmute and um, maybe share a few thoughts of experiences that might also just benefit the rest of the people on the call here, but happy to kind of pause here for like 2 minutes to see if anybody has any interesting cases to share.
Anyone, if you want to unmute yourself, please just raise your hand and I can unmute you. And if you want to share anything, you can also use the chat box.
Okay, I think we can
Yes, we can move forward.
move on to
Yes.
section 2. So what is a personal credit report, right? We talked about how important these reports are from like an agency perspective and how they're used. But really what it tells the lenders is like who you are, how much debt you have, and like how long you've had it for, how frequently have you applied for the credit, like how much credit are you using. So it really is a snapshot of a holistic, detailed view of like if you're making your payments in time, which obviously is a big determinant of like how good or bad your credit is, because these are the reports that are used to essentially determine the credit score that gets assigned to you. And we've talked a lot about these agencies, so now moving into like who these agencies are, right? Um, when you look at the three biggest agencies, they're Equifax, Experian, and TransUnion, which are three major consumer credit reporting agencies, super reliable in the market, where Equifax, for example, one of the oldest and largest credit reporting agencies in the US, it provides, like I said, credit reports, credit monitoring services to both consumers and businesses. And across the three, like they really gather data from various sources, including any lenders, banks, and public records. And this includes whatever we talked earlier, which was around payment history, utilization, length of credit history, and more. And they also offer sometimes special features, which is around like identity theft protection services, and a range of like other business credit services, including like certain risk management tools that might be helpful for small businesses. Experian as well, like, provides a lot of the consumer services like credit monitoring, identity theft protection, business solutions, including even marketing services and like data analytics, which some of you might find helpful. Um, and how these agencies really impact consumers and businesses, right? Um, so when you look at these agencies, they provide those detailed reports that we talked about. And this is what also could include like public records of like bankruptcies and any tax liens that might have happened on the business. They really calculate the credit scores, which will go a little bit into detail, but they're called like basically FICO scores, which lenders use to assess how risky a borrower might be. And a higher score obviously indicates like lower risk, and that eventually ties into the cycle of like better loan rates and better terms on the loan. And I think it's very important to, and I keep pressing on this point because they offer good services to monitor the credit activity. So it's in your hands to really ensure that, there is no potential fraud or like identity theft. And if you do see something, like biggest piece of advice would just be to kind of check those reports regularly and ensure that it's accurate, because it really determines like how much access of capital you have, and you're allowed to essentially, if you do come across any inaccuracy or something that's not right, you can easily dispute any accuracy dispute any inaccuracies in the credit reports, right? And by law, like these agencies, they must like investigate and like correct any errors that they came across. And understanding the role of these agencies really just help manage consumers like better like credit health, and like really enables businesses to make like informed like lending decisions. And I think that's why it's really just important to regularly keep checking that, to just maintain like a good credit standing and catch any discrepancies early if needed. Moving on to the next slide, which really breaks down like what a personal credit report information might look like. So as you see, like you'll obviously have like your name, including like variations, like your current or previous addresses, etc. Um, it also shows like the type of and the number of accounts that you have, details of different credit accounts, including any credit cards, mortgages, car loans, student loans, personal loans. It also shows the account information, whether that's like lender's name, account number, account type, when was it opened. So it really does have all the information that's needed. And there's something that you will not see or is important to just ensure that's not in the credit report is your marital status, your driving record, any medical history, even just like your checking and savings accounts balances. Like these are things that you will not find or should not definitely appear on your personal credit report. And then before going into that, I think another thing is there's credit inquiries, and it could really be kind of segregated into hard inquiries and soft inquiries, where the hard inquiries is like, requests for your credit report made by lenders or creditors when you apply for the credit. And these inquiries can really affect your score, like your credit score that we'll dive into right after this, and remain on your report for up to 2 years. And then you also have the soft inquiries, which is the requests made by you or any like potential employers or companies that are kind of conducting the pre-approval checks. And these do not affect your credit score and are only visible to you on your credit report. So just something to keep in mind. In terms of the public records that I mentioned, information about any bankruptcies, including type like Chapter 7, 11, 13, everything, the filing date, they definitely remain on your credit report for up to 10 years. So that's something that is obviously a major red flag. Details about any like tax liens, including the amount you owed and the filing date. Paid tax liens can stay on your report for up to 7 years, while unpaid sometimes may actually stay or remain like indefinitely. Um, and then any information around like civil judgments, including the amount, date, and like the court involved. Judgments can impact your credit for up to 7 years. So also something to like keep in mind. And then any information around debts that have been turned over to collection agencies, including the original creditor, the collection agencies, the amount owed, and the date when the account went into collections. That's all um, also something that shows up in your credit report and can stay on for almost about 7 years. So here's is when we move on to the scoring part, and you'll see that while not part of the credit report itself, the score is often, provided when you request your report, and the score is kind of like basically a number assigned to like how creditworthy you are. So it typically ranges from like a 300 to like a 850. And obviously, higher scores indicate like less risk, better credit, etc. And different score models that we see here, like FICO, Vantage, they're used, and some private lenders may also just use their own private models to kind of determine what number needs to be assigned. And you'll see here as well that here's kind of like a breakdown of you know, the different percentages assigned of like what actually goes into a score model and like how much weight it's assigned. And this helps you determine that, okay, if if I do have different types of credit, that only has like a 10% influence on my total score. If I do have past payment history, that's going to be a red flag because consistently paying your bills in time obviously positively impacts your score. And late payments, can significantly lower your score, as you see, because it does hold the highest percentage in the score model. Amounts owed for your credit utilization, this ratio really compares your current credit balances to your total credit limit. So keeping your credit utilization below 30% is generally what's recommended. Um, and outstanding, high balances on these credit accounts can definitely negatively affect your score. Age of the accounts also matter. The longer your history, the better. And then new credit, which is applying for any new credit can result in just hard inquiries that I mentioned earlier, which may temporarily lower your score. And then as well as opening, I guess, multiple new accounts in a short period can also be seen as super risky. The types of credit, like having a variety of credit types, whether that's your mortgage, whether that's your auto loans, etc., can definitely serve as a positive indicator because it shows that you're able to manage these different credits in a responsible way. And similar to FICO, you have the Vantage score, which is again another credit scoring model, which was jointly developed by the three agencies that I referenced earlier. And it was an alternative to FICO. And then it also had very similar key metrics to kind of analyze what goes into a person's credit worthiness. And it really just periodically is updated to reflect any changes in the consumer credit behavior. And it keeps updating. I think the latest version was Vantage score 4.0 or something, but it's increasingly used by lenders, especially for consumers with limited credit history. So just something to keep in mind. And consumers can, you can just access the score through various channels, including any credit monitoring services and financial institutions. Um, and then as you see, something that just a score scale that, puts it into perspective where the further right you are, you have an excellent credit score because you're considered to be low risk, and that's when you get the better terms and interest rates on your borrowings. Um, and then you can receive one personal free report every 12 months from each of the three agencies that we mentioned earlier. And it's really easy to just go on that website and download essentially your 12-month personal credit report once a year. And definitely be on a lookout, at the end of the day, these are your reports that speak to yourself and as well as your business. So just make sure to kind of have them be checked and make sure that they're accurate and there's nothing that stands out to you. And maybe make a short checklist to just see okay, what are the things that I'm kind of looking for in this checklist that needs to be addressed, which really helps in kind of determining. And then provide copies of any documentation to support claim, send any disputes that you see on the reports, and then request a new credit report to just ensure that the discrepancies have been solved. And then this is what is kind of a regulation law, which is the Fair Credit Reporting Act. And imagine say Sarah wants to kind of check her credit report to see what information creditors are using against her or her business to evaluate the credit worthiness. And under this law, essentially you're allowed to kind of, request that free copy. If you discover an error, you're allowed to dispute it. There's also a lot of privacy involved, so the lender must have permissible purpose under the FCRA to ensure that the report is accurate and nothing really is a discrepancy. As well as if, say, for example, your identity gets stolen or if there's fraudulent accounts opened under your name, this law kind of, ensures that there's a fraud alert or security freeze on your credit report to protect you and your identity and just make sure that there's no unauthorized access. This is just kind of like a snapshot of what it looks like in like real life. And then, like I said, a couple of things to just keep in mind, like best practices, like paying your bills on time, reducing debt, like using the credit wisely, like and ensuring that you're diversifying your credit, you're monitoring those reports, you're disputing any inaccuracies. And I think one thing that people forget in the entire process is to really maintain long-term relationships. So keeping your oldest credit accounts open and in good standing can really positively impact your credit score because it shows a pattern of you recurring, making those recurring payments and, never missing out. Um, and lastly, like I said, educate yourself, stay informed and just be proactive in addressing any conflicts or discrepancies that you see, because this is what's gonna eventually affect once you do plan on like, growing your business and moving from like that personal credit to like the business credit. And that brings us into like a good segue here to really see like when personal credit becomes important for your business, deter based on what stage of growth you're in. But before we move on to business, I'll likely just stop right here to see if anybody has any questions.
Please, if you have any question, raise your hand, ask your question. This is the time you can, you can ask question, and there is no any question is a good
Yes, please.
question.
Anything,
And
like there is
yeah,
no wrong question.
exactly. Just feel free to ask. You can, if you want to write your question, use the Q&A box or chat box to write your question. But if it's easier to ask the question, raise your hand. I will unmute you and you can ask your question. But take this opportunity to ask your questions. If there's anything that you are not understanding how it works, this is the time to ask the question. Looks like we don't have question. So, oh, let's see. There's one question here. So, Sandra asked, what if you had a corporate and personal bankruptcy 8 years ago? Now have a personal credit score of 740, no corporate history with my new company.
Sorry, Rituhi, you cut
So
off. Do you mind repeating?
no, the question is, Sandra asked that if someone has a corporate or personal bankruptcy 8 years ago, and now as of today, that person has a credit score of 740, and they have another corporation which has no like history of like bad history, how it will work?
And the other corporation has like no bankruptcy history?
The new one, there is nothing, but there was one, like if there is a prior bankruptcy history, it could be personal or business, but as of now there is nothing, everything is good. How it will play?
Yeah, I think
Sandra,
that's a
correct me if I'm like this is what you're asking. Closed old one. Okay. She mentioned that she closed the old one, open new one. New one is really new. So previously she had a business that she filed the bankruptcy, and and now she's asking how it will play out.
yeah, I think that's a great question. But a bankruptcy from 8 years ago, in my opinion, can still appear on a credit report, but its impact like fades a lot over time, especially if the person or the business has kind of rebuilt that credit responsibly like afterwards. So if like say for example, person A had like a bankruptcy 8 years ago, but now has like a 750 credit score versus person B never had a bankruptcy, it does not automatically mean that person B has like a better credit. Lenders look at both the score as well as the underlying report that I kind of mentioned earlier. And obviously, a 750 is objectively like a very strong credit score. So that usually means the person has rebuilt well, like it has done the on time like payments, it has had lower utilization and like aging accounts, etc. And chapter 7 bankruptcy, just to kind of get a little bit into like details, that stays on the report for up to 10 years versus chapter 13 only stays for up to 7 years. So even with a high score, some lenders, especially depending on who the lender is, whether that's mortgages, private banking, high lending, they may still care about the post bankruptcy itself. And other lenders care mostly about kind of like your current score, your debt to income, like your income stability, and just like what your recent payment behavior has been. So in practice, like for a regular credit card, like an auto loan, the 750 score may matter more than kind of like the past bankruptcy. But for something like a jumbo mortgage, or if it's like a partnership business underwriting, um, the history could still like raise questions. Um, so hopefully that answers the question, but let me know if that's clearer.
Thank you, Saloni. I just want to add, like, we are a CDFI, and for us, you look for the bankruptcy in the past 2 years. But like, if it is 8 years ago, generally it is not going to affect. Generally speaking, of course, we are
Yeah,
looking still, the patterns to see like if everything is going well at this
right.
moment. But generally, it shouldn't have like that type of negative effect on your case.
Yeah, exactly. That's a great question though.
Yes, it is. Thank you, Sandra, for the question. Doesn't look that we have any other question. So I think we can move forward.
Okay, perfect. So we'll move on to section 3 around like the business credit reports, where similar to how we talked about like personal, this also has a lot of the history that we talked about and how we have Experian, Equifax, and TransUnion. We have here similar agencies, but one of the populars for the business ones is Dun and Bradstreet. So you'll see here, these are the major players kind of like in the business reporting side of things, where they really focus on how the business is interacting with vendors and suppliers and how this business has managed business lines of credit and loans, and just the focus on like credit information from both lenders and business lenders. Um, so what information do business credit reports contain? This is where you'll see, you know, a lot of slightly similar things to personal credit, but obviously involves a lot around your DUNS number, your industry, what is the classification code for what your business is operating in. They will also be curious to hear what the payment data from suppliers and creditors have been, what is the risk scores and ratings, as well as legal structure, your corporate financial reports, any contracts, any departments from the federal government, any self-reported data, as well as business registrations, whether that's like state, city, or like county codes, etc. So that's what's important to kind of see as like a differentiator between a personal versus a business. In many consumer lending regulations, such as the FCRA that we talked about earlier, they don't automatically apply to business credit reporting, and they will still have their own procedures, however, in place just to make sure that any disputes that you see similar to like your personal inaccuracies, like determining how long information stays on the report, like etc. Um, and this is where you'll see that, we have a quick side by side to show that it's created by like consumer credit reporting agencies, right? Like both of them, whether that's business or like personal, there's many types available, and you have that variety of like scoring ranges and rating systems that really emphasize on like different factors because those are the key metrics that go into determining like how interest terms and like rates are um, determined. Um, and similar to just the best practices that we discussed earlier, they use credit monitoring services to kind of receive any alerts, check and see if information looks like up to date, etc. Um, and just a caveat that, you know, some of these services might be free and some of them you might have to pay like a charge to just kind of access that. And before even like going into that, like, you know, some people always ask me like, why is it even important to like have a business credit? And again, like this depends on like what cycle your company is in, but it provides like valuable insights into like a credit worthiness of a business, right? Your legal name, like a numerical representation. Like I think it's really important to like maintain that. And it provides like valuable information about like how your business is doing, how stable it is. And by understanding the components of business credit reports and how they're used, owners can kind of proactively manage their credit profiles and just strengthen their financial position. Um, and again, like regularly monitoring and just maintaining a business credit report is like super important, as well as for those who are still in the early stage where you're contemplating establishing a business credit. I think it's really important to just have it separate from like your personal because you want to ensure that your personal kind of protects like your assets in case any business related like liabilities come up. And if you also having like a good business credit profile increasing your chance for like qualifying for financing, such as like loans, lines of credit, like business credit cards, etc. And this can really provide the capital needed to grow your business, like, you know, invest in expansion, etc. And it makes it easier to establish relationships with like vendors and suppliers, especially when you look to like set up and like eventually grow your business, and also enhances your own credibility and trustworthiness in the space. Um, I know like some insurance companies and landlords also consider business credit when they're setting up like premiums or lease terms. And, you know, obviously a positive credit history, like a higher score, it might just result in like lower insurance premiums or just like a more favorable lease agreement. So that's kind of why it's important to know that. And lastly, one thing to think about is just like emergency preparedness, right? A financial safety net for any unforeseen circumstances or emergencies is extremely important, and it ensures that, you know, your business has like access to credit when needed, helping you kind of weather challenging times or like just seize unexpected opportunities. And overall, just establishing business credit is just essentially like important. So that's where you'll see like all of this. Things that we discussed, and I'll stop right here to kind of touch on in the next year. How do you think having a healthy business credit report could kind of help your business, or if anybody wants to maybe, you know, stop, share any experiences now contemplating to like the business credit side of things, that might be helpful for the audience.
Again, please feel free to raise your hand to unmute or write in chat using chat box or Q&A. Okay. Since we don't have question.
Okay, no worries. Perfect. We can move on. Um, so next thing we want to talk about is what is the current landscape, right? You'll see we'll dive a little bit deeper into the small businesses and just how these companies provide like credit reporting, analytics, and scores that we talked about earlier. And this kind of sums up like putting it all together, like, what are the things that are important when if you're in a lender's shoe that they look at, which is capacity, collateral, credit history, like conditions, like character. And that's when you see like the traditional loan underwriting that has kind of the five C's of credit, um, which is your capacity, um, if you're capable to kind of like repay those obligations. And a lot of the times, I think what's interesting here to note is the non-traditional data, and that refers to, which is kind of like the new and growing in youth, which is beyond any traditional like credit data that is typically used to kind of assess the credit worthiness, right? And it encompasses like a wide range of alternative data sources to provide insights into any sort of like financial behavior, whether that's related to like your personal or your business like landscape. And this involves like individual or businesses payments history with like non-credit accounts, which involves like utility bills, rent payments, or any sort of like subscription services. And these alternatives can, kind of provide you with like and show you the reliability that you might have like developed. Um, there's also analyzing any like bank account information allows them to kind of see how much cash flow you have coming in, what your income stability is, etc. Sometimes like social media profiles, online reviews, and any digital footprints also provide kind of insights into consumer behavior, what the preferences are, and just really assessing credibility. Um, there's also online lenders or like peer-to-peer lending platforms that gather and analyze alternative data to like assess the creditworthiness, as well as any like mobile phone usage data, including call patterns, location history, um, app usage can kind of provide insights into like, consumer behavior and just like financial habits. And the non-traditional data sources can also kind of include employment and income verification services that provides like real-time access to employment and income information. And, this kind of helps put into picture like what's needed, what's not. And this is exactly like what I talked about. It's not as prevalent, but it's definitely like a field that's like growing. Um, and when you're someone who's providing like a startup loan, obviously it's important to kind of assess like everything, um, versus someone who's like in a mature stage where you might just have all of these five C's analyzed to like a some certain degree and not like in a comprehensive manner. Um, and that's when it becomes like really important. But I think the best practice is to just really, you know your credit, like know your lender and know your rights. Because at the end of the day, like it comes down to your personal and business credit, and you want to make sure that you're getting access to quality financing at like better terms and um like better interest rates, because at the end of the day, it's going to help you. Um, yeah, so I think this is just like I said before, access to credit reports may just be super useful in kind of helping you evaluate risks when you're hiring employees or just working with customer clients. What if you're on the other side of things, right? And reporting to credit reporting agencies, this really may support your ability to manage risk when you have a lot of transactional activity going on with customers. Um, and lastly, I think these are just some high level summary of what we discussed. And it goes back to just, the reporting agencies, their importance, what they are, what score models are used to like determine that. Um, Similar to personal, you have business where Dun and Brad is actually the more popular one. And these reports include a lot of the things and a lot of the things that should not be included. Many types of scores are available with like, similar ranges, and each of those key metrics have like a certain weight percentage assigned to determine like how much weight goes into it. And then they're important for your business, like, managing both personal and business scores can really help you establish like strong histories. And then, these are things that can be used in different makes to make those final decisions, and just having that healthy history really helps. Um, that's pretty much it with the presentation, but I'll stop here to see if there's any like questions or anything particular or any other topic that the audience might want to touch on.
Okay, so thank you so much, Saloni. As always, lots of information, good information actually for the business owners to pay attention, because like again, personal and business credit are not, at least in the initial phase of the business, it's not separate. And again, speaking about our side, we are a CDFI. Generally speaking, when we on all our like loan cases, we look on the personal credit. So, and as a person, you are a guarantor for your loan. So it's extremely important to, understand both works, together. So it is extremely important to look on your credit, personal credit, and in the same time build both of them. So this is the time for the questions. If any questions you have, please raise your hand, ask your questions. If you feel more comfortable to write your question, use the Q&A box, write your question. If you want to ask your question, raise your hand, and I will unmute you. You can ask your question. Whichever works better for you, please go ahead. Any question you have, just this is the opportunity to ask the question. Lone, question in regards of like starting the a credit for the business. Okay, so it could come in a form of like if we get a credit card for the business, will it like that would count for the business credit, correct?
Yes, correct.
So any other thing, but like definitely banks are reporting for the business. So anything else that it can help, to build up the credit for the business. Any like emphasize any suggestion that you can, just emphasize once again, what are the things that, if the person is good, on the personal level, but like would like to know, okay, what else I should do? I have a business credit card. What else I should do if I want to like have a good business credit?
Yeah, definitely. And I think this is where a lot of the small businesses like kind of miss the opportunities, like building business credit, obviously is very separate and important from your personal credit. And I think obviously the first thing you want to do is like, form the biggest levers, right? Like the LLC or corporation can kind of help create that separate from like your personal finances. So getting the EIN from IRS, like establishing like a business like bank account, like, having a business phone, email, like address, and then like you said, like getting a business credit card where you can put all those expenses in. Those are usually the good like starting points. And then banks like seeing like, deposits, like cash flow consistency, like low overdrafts. And I think for start, like it's the easiest way is to just kind of get like vendor trade lines, and certain vendors, they report these payment histories to the credit rating agencies that we talked about, like Dun& Bradstreet, Experian, Equifax, and this involves examples like office supplies, like packaging vendors, or even like fuel cards, and paying like net 30 accounts early. That can really help establish like business credit like pretty quickly. Um, and then definitely getting like a DUNS number, which is the agency that we talked about. And that is like essentially your business identity profile, and then that becomes a cycle of like, ensuring that your utilization remains lower, paying early and like not just on time, and like not maxing out like cards, with like startup expenses, unless it's like absolutely necessary. So, I think that, and then obviously just really avoid mixing like personal and business when it's easier when you're like still starting out. So, because that would really, hurt your underwriting credibility, like your bookkeeping, like your tax clarity, etc. And then I think start building those relationships with like banks before like needing money. So a business with like deposits, like treasury usage, like payroll, merchant processing, like they often get better treatment than someone appearing only when they need like a loan. Um, but also to like not put any like pressure, like business credit profiles does strengthen a lot after like 12 months or like after 24 months, and especially after like those multiple like tax returns. But yeah, those would be like some things to keep in mind.
Thank you so much.
Mhm.
Uh, so I don't see any other question. Again, we will wait for another maybe 2 minutes. If anyone has any questions, please ask your question. If you don't have a question, like uh, if you want to leave, you can leave. We officially finished the workshop, but we will wait here for another maybe 2 or 3. Okay, there is a question. I have a no interest credit card that has been open about 4 months. I missed one payment by 2 days, and that canceled the no interest option. I want to cancel it and start over. My credit score is over 800. How much will it hurt my rating if I cancel it? Is there something better to do?
Okay, so just to backtrack and be slower, so had the credit card for 4 months and you said they missed one of the payments?
Actually, the person delayed 2 days. The payment was for 2 days, missed one payment by 2 days, so they canceled the free interest option. So the question is, should like he canceled, the card completely and started over. The credit score is good, 800. How much will it hurt if
That's a great question. And she hasn't canceled it yet, right? Like she's
no,
contemplating
no,
if she
no,
should
yeah,
cancel or not.
yeah.
I think if your credit score is like around 800 after like that one missed payment, that's actually like a pretty solid sign in my opinion. And one mistake on like a 4-month-old card is not like catastrophic, obviously, especially if it was like corrected quickly. Like I think it was just missed and like delayed by like 2 days, which is like totally fine. And I would definitely not rush to like cancel the card. And I think a lot of the times canceling the card actually hurts you more because it may kind of reduce your available credit. Like it just increases your utilization percentage and like kind of shorten future account age contribution. What matters most now is kind of just like, was the payment more than 30 days late? Which definitely it wasn't. In your case, it was only 2 days late. And did the issuer kind of report it to the credit bureaus? And has the balance now been fully paid, which it looks like it has been paid, given you said that it was only delayed by 2 days. So just losing the 0% like interest promo because of like a late payment, but it wasn't really reported as like a 30-day like delinquency, then it's like totally fine. Like there is no long-term impact. It's like pretty limited. But I would definitely keep the card open and, turn on like maybe auto pay immediately if that's helpful, but use it lightly and then pay in full consistently for, I would say, for the next like 6 months or like 12 months.
Thank you. And
Mhm.
generally, I would suggest in those cases, like immediately contact your creditor, like talk to
Yes.
them. In most of the cases, they change the terms. So because they see you are like you are trying to address the issue fast. So they like in my personal experience, they were really like, cooperative. So and it's understandable, we are all humans. You may, forget something by mistake. Mistakes can happen. So just if any such thing happens, please contact your creditor as soon as you realize that something like this happened. Try to see if you can get the same, same terms back. In this case, it was like free interest. So see if you could, get the get it back. But if that is no more an option, so what I would think of, like, rather than to close this, if you are thinking to open another credit card, I if it is with the same creditor, I don't think like closing the card and opening again it will help you, because they go based on you as the person, and the history is there. So I am a little like, Saloni, correct me if because, like, if for example with the Citibank I have a card which is free interest, and because of this delay, then this option is removed. Will it help me to close and open another one? I
I don't I think if it's a one-off situations, a lot of times, like you said, goodwill makes a huge difference, kind of just contacting the issuer and like letting them know that, this is what happened and like this is why it was delayed. A lot of the times they're very flexible in understanding. Canceling is obviously the last resort, but it definitely hurts your score more than just kind of, ensuring that you kind of stay consistent for the next like few months. And you've had that history for 3 months, right? Like a delayed one. And it's not like you missed it and you never paid it back. If it's a 30 plus day delinquency, then it might sometimes affect more. But generally, like it's recommended to not just like cancel it fully.
No, no, but the question here is the interest free. That
Right.
option is no more there. So I would think of like, but my question is like, if she cancels, like with again, I'm using the city example, but if there is a interest free card, and if this happen, and can I cancel this and get another one? I don't think this will, be an option, but again, correct me, because like it's already, as a person, every like card is linked to your personal information, so the history is there. So if they are not
Yeah,
ready to offer you that interest anymore, so the new card, I am a bit like skeptical if they will give you a new card with the same
exactly.
terms. But
Yeah.
if there is another like creditor who is offering a free, interest credit card, I would say just go ahead, use it. You can, like, don't cancel this card, but don't use it.
Yeah,
If
exactly.
yeah,
That's
yeah,
that's what that
don't
was
use it,
going.
let it stay, and but don't cancel it. It will automatically be canceled after a while if you are not using it. But
Exactly. So
yeah,
that goes back to my previous point that,
yeah.
keep it open and just have the utilization be low on that card. And if the first move would just to have that 0% promo kind of like reinstated, you can ask, but obviously that approval is like not guaranteed. If it's like a one-time thing, obviously. If it's like a repeated pattern, then obviously you know that you're in the red flag, like it's never gonna kind of work out. But definitely move to like another creditor if the promo is like gone and you're carrying like a balance and apply for like a new 0% balance transfer card and like move debt to like a lower APR product if that's like an option.
Okay. I hope we were able to answer the question. So we don't have any other question, and we are already past 12. So if there is no more question, I just want to say once again, thank you, Saloni, for your time, for willingness to volunteer your time and do these workshops for us. And thank you everyone for your time and for joining this workshop today. I hope you benefited the workshop. And again, if there is any question, please feel free to connect with us and we will try to find, if we cannot answer ourselves, then we will try to find and connect you with the experts in the field to answer your questions. And by that said, I want to wish everyone a good rest of the day. And thank you again. Thank you, Saloni.
Awesome. Thank you again,
Yeah,
everyone.
thank you.